All right, let's get right into it. We need to talk about the global economy because, frankly, it's getting really weird. On one hand, you've got markets absolutely soaring, but on the other, economies are fracturing, and for the first time in a while, the world's central banks are all going in different directions. So let's try to make sense of what's happening.
So here's the central puzzle, right? The S&P 500 is just shattering records day after day. But when you lift the hood and look at the global economic engine, all you see is fragmentation, conflicting signals, a whole lot of confusion. So how can both of these things be true at the same time? What is really going on?
Well, the answer really begins with the most powerful players in the game, central banks. For years, it felt like they were all marching in lockstep. Not anymore. Now they're all singing from completely different song sheets. And this, right here, is what we're calling the Great Divergence.
So what do we actually mean by monetary policy divergence? Well, think of it like this. The world's biggest economies are all cars on the same highway. But suddenly, one driver is slamming on the brakes, another is flooring the gas pedal, and a third is just kind of cruising along. You can imagine the kind of chaos that creates, right? It sends these unpredictable ripples through every single market.
To get a handle on it all, you can pretty much break them down into three camps. First up, you've got the easers. That's the UK, Canada, Australia. They're cutting interest rates, trying to give their economies a little boost. Then you've got the holder, and that's basically just the US Federal Reserve, holding steady for now. And then in a league of its own, you have the hiker, the Bank of Japan, doing the complete opposite and actually raising rates.
I mean, the differences here are pretty stark. The US Fed is holding firm at a high rate, just watching the data come in. The Bank of England, they want to ease up, but they're kind of stuck with inflation that's still stubbornly high. And then there's Japan, the total outlier, tightening its policy to try and save its weak currency. These aren't minor tweaks. This points to a fundamental disagreement about the true health of the global economy.
So what actually happens when the world's financial conductors are all playing in different tune? Well, you get some really strange and often contradictory signals popping up in the markets. Let's take a look.
On one side of the coin, you see what looks like pure optimism. The S&P 500, a massive benchmark for US stocks, is hitting new all-time highs. The signal seems clear. Investors are feeling confident, they're hungry for risk.
But, and this is a big but, at the exact same time, gold is also hitting an all-time high. Now, gold is the classic thing you buy when you're scared, when you want safety. So, wait a minute, are investors feeling risky and scared at the same time? How does that work?
And to make it all even stranger, the VIX, which is Wall Street's so-called fear gauge, is incredibly low. It's basically asleep. A low VIX suggests there's no fear of volatility. So the market is saying, everything's fine, calm seas ahead, while simultaneously buying up risky stocks and safety assets. It just doesn't quite add up.
What this really points to is a new reality. Gold isn't just about hedging against short-term fear anymore. It looks like it's becoming a hedge against the central banks themselves. I mean, if you expect a whole bunch of countries to start cutting rates, which devalues their currencies, you might buy gold as long-term protection against that very trend.
This divergence is also creating huge waves in the currency markets. The US dollar, it's strong, which makes sense because the Fed is holding rates high. Meanwhile, the Canadian dollar is getting weaker after its economy actually shrank, pressured by things like US tariffs. And then there's the Swiss franc, once the ultimate safe haven. Now its rates are near zero, making it so cheap to borrow that it's become a funding currency. Investors borrow francs on the cheap just to go buy higher-yielding assets somewhere else.
Now, we can't talk about the U.S. market strength without talking about the elephant in the room, the artificial intelligence boom. It's a massive force. But even this incredible story isn't immune to the world's new fragmented reality.
I mean, just look at NVIDIA, the absolute poster child of the AI revolution. Their latest earnings were just staggering, a 56% jump in revenue year over year. This is the kind of explosive growth that can single-handedly power the tech sector and pull the entire market up right along with it.
But here's the catch. Hidden in that same glowing report was the fact that NVIDIA sold 0 of its high-end chips to China. This is a direct result of geopolitical tensions and trade restrictions. It's a huge reminder that even for the market's brightest star, global politics can create a massive roadblock for future growth.
And the political risks aren't just international. Right at home, there's growing pressure on the US Federal Reserve that threatens its independence, and that creates a whole other layer of uncertainty. If markets even begin to suspect the Fed's decisions are politically motivated, it could really damage the dollar's credibility, and that's a major risk that might not be fully priced in yet.
So what we have is a market hitting all-time highs, but it's fueled by a strange mix of contradictions, geopolitical risks, and these hidden fragilities. And all of this has led to a massive, high-stakes bet that is just about to be put to the test.
Just look at this chart. It shows that speculative traders have placed a huge bet that the S&P 500 is going to fall. That net short position has grown significantly. It means more and more people are piling onto the belief that this rally just can't last. In the business, we call this a crowded trade. And whenever a trade gets this crowded, it creates the perfect setup for something called a short squeeze. So here's how it works. If some unexpectedly good news comes out, all those people who bet against the market have to rush to close out their positions to stop the bleeding. And how do you close a short position? You have to buy back the stock. This sudden tidal wave of forced buying can send the market shooting upwards, way more than the news itself would justify.
So what's the potential trigger for all this drama? Well, it could be the upcoming U.S. August jobs report. The consensus is for a pretty weak number, around 75,000 jobs. Now, if the number comes in strong, that could actually spook the market, because it means the Fed has no reason to cut rates. But if the number's weak, it reinforces that whole bad news is good news story, making a Fed rate cut almost a sure thing. And that could be the exact catalyst that triggers a massive short squeeze.
So, after looking at all this, central bank divergence, contradictory market signals, a high-stakes data release on the horizon, what's the big takeaway? What does it all mean for us?
The biggest takeaway is probably this. We're in a new economic reality. The old, simple playbook of just risk on versus risk off doesn't really apply anymore. In today's fragmented world, you have to understand the unique story and the why behind each central bank's decisions. That's what's really driving the markets now.
Which, of course, leaves us with one final huge question. Is the incredible confidence we're seeing in the U.S. stock market built on a solid foundation of real innovation and growth? Or is it maybe a fragile house of cards, perched precariously in this world of divergence, just waiting for the next strong gust of economic wind to blow it all down? That's what we'll be watching. Thanks for joining us.